this one here, I think the next two slides that you have here, and this, by the way, Ivy put these slides together, so thank you very much, Ivy,
You're welcome.
for doing this. But these next two slides kind of show another group of buyers that have been, I guess, treated separately or more favorably, I guess. Maybe you can walk us through that.
Sure. So on this side here it's a LLPA waivers. So there are certain part of a group of people that will not get impacted by this change. Any first-time home buyer, any loan fall through home ready, home possible, FHA, VA, first-time home buyer, cash out, student cash out refinance is not going to follow the changes. Also, first-time home buyer, if their income is qualified in that arrangement, they are not following the LLPA changes. So also, as a portfolio lender, all type of a portfolio loan, jumbo loans, we have our own rules to follow. So we are not follow any of Fannie Mae changes as well.
Right, because you're not selling the mortgages to them.
Yes, because
Okay.
we're gonna keep the service, we're gonna keep the mortgage.
Right. So, and that would be anything above the 726,000,
Correct.
726,000.
Correct. So any loan amount above 726,000, we keep it. We don't need to follow the rule. And then, all type of portfolio loan.
So just to sum up here, so basically first-time buyers, home buyers, and I guess there's two definitions for that. Well, let me finish my, first-time home buyers are completely waived of all these adjustments that we saw
Right.
from those two tables.
Right.
Okay. Does that include a DTI adjustment as well?
It is.
But
It is.
I guess from a underwriting perspective, banks, if you had a 50% DTI, you probably wouldn't underwrite them anyway.
No. Yes.
It doesn't waive your
Standard guidelines.
standard guidelines.
Correct.
Thank
Correct.
you. Okay, so my understanding, they define Fannie and Freddie, or the FHFA define first-time home buyer as not having owned a home in the last 3 years.
Mm-hmm.
And then the second requirement is this area median income.
Correct.
So I know you guys have like I've actually been on it, is where you search like a town like Wellesley, and you find out what the median income, and as a borrower, if your income's 120 or below that,
Correct.
You
You
know.
are not follow this rule as well.
then you can qualify for this. But you have to meet both those requirements.
Yes.
Okay.
It's one or the other. So less.
Oh, it's one or the other.
Yes.
It's either or. Okay.
Yes, either
Okay.
or. 100% less area median income, 120% in high cost area. So it's one or the other.
Okay. So, and then this chart here, I think is, we'll get to that in a second. But so, on this one, going back to, I'm a borrower, okay? If I have a credit score of 720, am I going to be paying a higher rate than somebody who qualifies for a first-time home buyer loan, this home ready or home possible loan?
So if you are not first time home buyer, yes, you're gonna hit on the regular adjustment. If you are the first time home buyer, 720 score, then you are not.
So you quoted me the par rate or the base rate
Yes,
for 30-year fixed, 5.875. That's today.
that's the
Obviously,
base
that changes every day.
rate.
So, as a first-time home buyer, if I qualify, that would be the rate you charge me.
Correct.
Versus if I am go back up here, say I have a credit score of 720, let's just assume 80, let's just say that's 20% down. We're good citizens here, okay? You're gonna add, for me, the guy with the high credit score, 20% down payment or more, a 1.25% higher interest rate.
So depending on your income, is your income fall through that 100%?
Yeah, but say I don't qualify for that first time home buyer.
Then you are not hit by this change.
If I don't qualify as a first time home buyer, I would be hit by that, right?
Yeah, if you are not qualified, then you are hit by that. If you are qualified, then you are not.
So as a previous homeowner, I'm going to be paying a higher rate than somebody who's buying first time.
Correct.
And intuitively, that doesn't sound right because they sound like they're a higher credit risk.
Technically, yes, but with this new changes, if you are not considered first-time home buyer, and if your income is not in that arrangement, then you'll get hit for that.
Right. So, okay. So, probably from a finance, it doesn't make a lot of sense, but if I'm a first-time home buyer, I'm loving it. So,
Right.
or if I have low income, I'm loving it as well. So,
Yeah.
so that's probably, but for your perspective, this is all new.
This is new.
Is the Home Ready and Home Possible new as well? Or is that?
No, Home Ready, Home Possible is Fannie Mae product.
Right.
It's their product for first-time home buyer. That's how they quote the name. We always have that.
So that's not new.
Yeah, it's not new. Correct.
Is the waiver the LLPA?
LLPA, yes, the waiver is for that as well.
But is that new as of May 1st? That waiver, or was it waived before May 1st? That's what I'm asking.
Oh, okay. They have a favor rate, but previously I have to do some research to see if there is an adjustment as well. But always Fannie, their first-time home buyer program, for those home ready, home possible, they always have a favor rate, a favor cost.
Okay, right. So that's not really new then. So
Yeah.
So this is okay. Okay, good. No, that's interesting. So I wasn't aware of these little changes.
Gotcha.
I learned the other day about Home Ready and Home Possible, and then one was Fannie, one was Freddie.
Right.
And okay, so good. You're teaching me a lot here, actually. So
Thanks.
that's good. So that goes on to here, and this is also for new homeowners.
Yes, it's for first-time home buyer as well. Home ready product. You get the credit for that.
Oh, okay. So is the right way to think about it? I can get up to $2,000 in credits.
You can get $500. This is each different product. They give you $500
okay.
credit.
Okay, gotcha.
Yeah.
So this is just for home ready, I guess.
Yes.
Okay, gotcha. Okay. So first time home buyers, there's a lot of
It's
opportunity
always-
out there.
yes.
So
Yeah, always first-time home buyer have a lot of opportunities and advantage as
that's
well.
good. No, that's good. I wasn't aware of that. So MI is another thing. So we've talked about the LPA adjustments. Okay. Just for the record, when we started off here, we talked about that. The David Stevenses of the world think there's some politicization of the process, but the head of the FHFA, Sandra Thompson, would just say that they just recalibrated the numbers, which they hadn't done in a while, and now they think the risk is better aligned with the different credit scores. So who knows? I'm just,
Right.
but there's two sides to it. We're not here to decide that. Mortgage insurance, how does that play into it?
So mortgage insurance for any down payment below 20%, that will be a hit for mortgage insurance. So with the new changes, it might make sense if it makes sense for someone to go with lower down payment and buy a temporary mortgage insurance. We have to run the scenario separately. But mortgage insurance this is something for someone typically do not have enough down payment.
So if I go back to this slide here, back to 23, remember we talked about it didn't make sense that the lower down payment here, just look at this one. So at roughly a little less than 20% down, but greater than 15, it's 125. But the lower the down payment, you're paying less, getting less adjustments.
Correct.
But the flip side of that is you're paying higher mortgage insurance too. So I guess at 20%, I'm not paying any mortgage insurance, so my fees
Higher.
So I guess that's one factor we haven't considered when we're looking at this by itself.
Right.
Just that, I don't know if you know this, but does it wash out? I mean, in other words, am I paying? Here it looks like I'm paying less for a more riskier loan, but ultimately I'm paying mortgage insurance on top of that. is it kind of balance out, in other words? Like the fee that I'm paying?
Sure, that's a very good question. So if I have to pick and choose between the high cost upfront versus the mortgage insurance, afterwards, depending on customer's scenario, I might to go with the lower cost. Just
So
put
you
down
would
the-
direct your clients because of to the 95%.
Correct. So this is my suggestions. Given on today's interest rate, changes, right? We are gonna be looking to refinance at some point next year, or so when the rate comes
Hopefully.
down,
We'll see,
right?
we'll see,
Hopefully. So especially if someone that not looking to stay in a property for a certain period of time, for short term, whatever reason, it might make sense for them to go with pay a temporary MI because we can always recast the loan to get rid of the MI, and then usually after closing, given like 3 months to 6 months, if borrower have sums to put back to principal, lenders be able to recast the loan. So in that way, the MI will be removed.
So if I want to recast my loan, or I guess another way to say, have someone review it to see if you're really recasting it just to see if I can get rid of MI, right?
Right.
So if I were to do that, I would come to someone like you.
Sure. So typically it's loan servicing. So every loan closing, we have a loan servicing department handles that.
Right.
Normally I see borrower come back asking for recast if they have a lump sum of a good amount of money they want to put down towards the principal, and they want to have they want to see what the saving is on the monthly expenses.
Right.
So once we recast the loan, it basically recalculate everything.
So you're looking at the equity, the debt, and so forth.
Right. So the payment can bring it down on that way.
And there's two ways. So they can. So if I had, let's say, a 15% down payment or 15% equity in my house, I could pay the additional 5% just to get rid of the MI.
Correct.
Okay, gotcha.
Yeah.
I gotcha. But there's alternative ways to get rid of that too. If I go back to your slide here, I think. I'm not sure this tells us what we want to know, but you and I were talking earlier is that I could hit that 20% mark a couple of ways. One, I could pay down my debt, or market appreciation,
Correct.
or a combination of both.
Correct.
Okay, so, okay.
Yeah.
All right,
So
good.
mortgage insurance, it's a small cost, and we have a solutions behind. So I would say, if I have to pick and choose from paying additional interest rate on a monthly basis, because the loan amount typically is 30 years.
And it's fixed.
Right?
And
It's
and
fixed.
if you have a good rate, why do you want to change it?
Correct. But even though we have to looking into refinance at some point, still, there's big cost behind. So, I mean, for certain borrower, if they have a situation, if they end up in a situation where we have to choose lower down payment to get rid of the cost, I will suggest them to do so. Because after closing, they can recast the mortgage, and then they can get rid of the MI pretty easy.
But typically you wouldn't do, somebody wouldn't recast with less than a year, would they? Or, I mean, is that?
I see that before. I have a borrower recast their mortgage in 4 months.
Okay, so that means they must be putting down money, is that, yeah,
Yes.
okay. All right, good. Does it require an appraisal too?
No, it doesn't.
Okay, so how's that market value determined on the house?
It's not going to be changed, the property value. It's basically they recalculation the loan amount, and then the interest rate will remain the same. They just have to recalculation. Say you borrow 100,000,
Yep.
right, at the closing. 3 months later, you bring it back 50,000. So now the loan amount is 995,000.
Right.
So the difference is payment between 95,000 versus 100,000.
Gotcha.
So the saving is right there.
Okay. So So, we talked about mortgage insurance, we talked about the changes to the loan level pricing adjustments to mortgage fees being charged to borrowers. So, what are you advising, are you advising any differently than you did pre-May 1st? Is anything changed in your mind? Except for, obviously there's changes, but does it really affect borrowers in this market?
I don't see any changes. We talk to borrowers all day long. I don't, to be honest, I do not see any more.
Probably most of them aren't aware of what's going on, so.
Right, I don't see my borrowers get demotivated because of the change. Yeah, of course, they have to pay additional costs right now, but this is something across the board. So for someone, the changes is for someone who have to pay slightly higher at the for the cost, and also on the other side, it's motivate someone, they are paying less, can motivate them to buy.
Right.
It's time to buy.
And I guess after a year of the Fed raising interest rates by 500 basis points, these adjustments probably look like peanuts to them. So
Correct. So we want to look in, in the whole picture, not just the interest rate cost. We want to see what the home appreciations and what the real savings behind the thing.
Well, that kind of brings us to the next topic, and this is the rent versus buy question that everybody's always asking,
Yeah.
So why don't you walk us through this example that you put here?
Sure. So I'm using a Middlesex County market values is somewhere, around 700,000.
Okay.
So say in that area, typically rental for single family is around 3,900. This is the report came from MBS Highway. Yes. So the MBS Highway, they give us the access, they help us do the market analysis. So that's from them. So we pick the Middlesex County as an example. For someone to own a house there, the property market value single family is around 700,000. And renting there is around 309,051 somewhere in that arrangement.
So that's year one.
That's the year one, yes.
Okay.
As interest rate goes up, but also the rents increase every year as well. So don't forget about that, right?
And this is a constant increase of 6% every year.
Correct. You're not getting a fixed rent, every year. So everything's increasing. So we're using today's interest rate, 5.875 30 years fixed. So for someone that owns a 700,000 home, they're paying 3,300 on the mortgage, and they pay insurance, and they pay property tax, But on the other side, if someone's renting, they just pay straight flat rent.
Yeah.
But let's take a look here on the chart.
So did you look across here? So this is the annual rent increase of 6% every year?
Yes.
Okay.
So,
and that's really like these purple lines?
Mm-hmm.
Yeah, gotcha. Okay.
Yeah, so we can see the rents are increasing every year on the purple lines, right? From year 1 to year 9, as you can expecting. But on the blue side, when you see the ratios, the mortgage payment will remain the same. And
It's fixed.
It's fixed, correct.
That's why I was telling people like a couple of years ago,
correct.
At those rates of 3.5%, 4%, why wouldn't you want to lock in for 30 years?
Correct.
Why wouldn't you?
Exactly. When you're in a no rate, environment, you always want to go with the
exactly.
the longer term because it's a safe.
So look, so just mathematically, the way there's another slide that breaks it down, but you're paying 4,525 per year if you buy at this rate.
Monthly. That's
right.
a monthly.
That's a monthly rate.
Mm-hmm.
So what Ivy's done is, she started off in year one, 3,951, grossed it up 6% every year. So saving money renting, not much, paying more renting, then continually paying more.
Mm-hmm.
Okay, and I think the next slide you get to, so this first line here is basically saying, over 9 years, I'm saving. If I just look at what I'm paying for mortgage versus renting,
mm-hmm.
I'm saving myself, just saving $47,883 in cash.
Correct.
That's real dollars.
Yes.
And obviously that would change, like if it was 5 years, it'd be a smaller number, or 3, you know.
Yes.
So,
Yes.
and certainly your growth rate of 6%, I mean, that could be less depending on, but I don't know if we're ever gonna hit that low interest rate environment again, so. But go ahead, yeah, okay, so.
So here we see the cash flow difference between you own your own house and versus renting. And the cash flow here, we're looking at 9 years, you're saving $47,883.
That's good.
And that's not including the appreciation gain on the property itself in 9 years term. So after 9 years, assuming that property value goes up 4.85% every
Right.
year.
It's an assumption, right?
Right. So after 9 years that you own the property, the value of the house is over $1 million.
Right.
So the gain from the appreciation is $375,000 there already.
And then you have the gain on the amortization as you pay off the mortgage.
Right.
You have more equity and so forth. So.
Correct.
Correct. So I guess then I guess the next slide you look at is talking about, so what is your gain if you hold the home 9 years?
Mm-hmm.
So if I add up my appreciation gain, my amortization tax benefit, initial closing costs, which is a hit, cash flow difference, which we talked about.
Mm-hmm.
All these numbers added up, we get a gain on my home of roughly $450.
Correct.
Good? So, okay. But again, there's a lot of assumptions in here, but I think we all recognize that over time, owning a home, if nothing else, it's a forced savings account.
Of course.
You're building equity, you're saving money, and a lot of people rely on that for retirement too. So.
Yeah, definitely. I think owning a home is a better way to save and to invest as well.
Well, great. So if people have questions, they should just call you, or.
Sure. Yes. I have my contact there, my cell phone.
We'll put it down in the YouTube, remarks, and thank you very much for coming in. This was great. I learned a lot.
Thank you. Thank you for the opportunity to discuss.
All right. Hey, thanks everybody. Hope you enjoyed.
Yeah. Thank you.